Hello everyone, welcome to the video. Today we're going to be talking about the PE ratio, what that is, how we can use it to value stocks, and if we should even be looking at that in the first place. What is the PE ratio? PE simply stands for price to earnings. What this means is the ratio can be found by taking the share price of the stock divided by the earnings per share. This ratio is useful because we can compare what we can buy the company for with the amount of money the company is making. We can also use the PE ratio to find the expected return of a stock. For example, there's a stock selling for $75 with earnings per share of $5. With this example, the PE ratio will equal 15. The meaning of what this PE ratio represents can be remembered usually using the following sentence. For every $15 I spend buying this company, I might expect $1 of profit 1 year later. This sentence is the key to using the PE ratio to value a company. The sentence can be used with any PE ratio simply by entering it into the sentence. Okay, now let's look at some examples of stocks and seeing what their PE ratios are. Here we have Finviz.com, my favorite website for stock research, and using this website we can find the PE ratio for any company. Let's say we want to look up the PE ratio for Apple. Here is Apple, and if we look right here, you see PE ratio 22.47. So if we use the sentence we just went over, we can say for every $22.47 I spend buying this stock, I can expect $1 of profit from Apple. Let's try another one. We can do Facebook. And here we go. We see the PE ratio is a little higher. It's 31.94. And what this means is for every $31.94 we spend buying Facebook, we can expect $1 in profit 1 year later. Even though the PE ratio can give us a basic insight into the company's value, by itself it's not a very effective method used to value companies. This is because the PE ratio of a company is constantly changing. And the PE ratio consists of two parts, the price and the earnings, and we expect the earnings of a company to increase in the future if the company is making more money as time goes on. Another way of saying this is the PE ratio does not account for the company's earnings growth. And the earnings growth is simply the rate at which the company's earnings grow. If we know the earnings growth rate, we can easily make predictions about how the PE ratio will change in the future because we can see how the earnings part of PE ratio can change in the equation. So that begs the question, what is a good PE ratio to buy a stock at? Here we have Peter Lynch, one of the best investors of all time. He was the former manager of Fidelity's Magellan Fund. I think he made something like 29% a year over the 10 to 15 years he ran the fund, and he wrote one of the best books on investing I've ever read, One Up on Wall Street. I'll put a link to that in the description. And here's what Peter Lynch says about the PE ratio. The PE ratio of any company that's fairly priced will equal its growth rate. If the PE ratio of Coca-Cola is 15, you'd expect the company to be growing at about 15% a year. In other words, the higher the stock's market price is to its earnings, the faster we should expect the company to grow to make up for the high valuation. So, how can we compare the PE ratio to the company's earnings growth rate? Thankfully for us, there's a ratio for that. It's called the PEG ratio. And what the PEG ratio is the PE ratio divided by the earnings growth rate. If we take Peter's example of Coca-Cola and say that they have a PE ratio of 15 and their earnings growth rate is 15%, the PEG ratio would be taken by taking 15 divided by 15, which would equal 1. And because Peter Lynch says that this means the company is fairly valued, if the PE ratio and earnings growth rate are equal, the PEG ratio will always equal 1, and that will mean the company is fairly valued. However, if the PEG ratio is less than 1, the company will be undervalued because the growth rate will be higher than the PE ratio. And using that logic, if the PEG ratio is over 1, the company will be overvalued because the earnings growth rate will be lower than the PE ratio. And again, we can go to Finviz and use that to find the PEG ratio of any company. Here, Facebook, and the PEG ratio is 1 right here, 1.51. So again, what this means is that the company is potentially overvalued because the earnings growth rate is lower than the price to earnings ratio. And we can see that right here. The earnings growth rate over the next 5 years is 21.2%, and the PE ratio is 31.94. So, we can clearly see that the earnings growth rate is lower. If we go to a company like Google, again, we can see their PEG ratio is really high, 2.81. Even though the company is growing at 10% a year, their PE ratio is 28. So this would mean that it might not be a great time to buy a company like Google right now. Okay, now we have a little exercise. The question is, which of the following two stocks is cheaper? Company A has a PE ratio of 3 and company B has a PE ratio of 20. I'll give you a couple seconds. You can pause the video and try to figure it out. Okay, so which stock is cheaper? And the answer is we don't know. And why don't we know? We know the PE ratio, but again, we don't know anything about the earnings growth rate, so we cannot make accurate predictions about the company's future performance. Company A has a lower PE ratio, so you might assume that company A is cheaper. However, what if I told you the earnings growth rate was 1% a year? This would mean that the PEG ratio would equal 3, and that would make the stock overvalued. However, if I told you that company B had an earnings growth rate of 40% a year, the PEG ratio would be only 0.5, which would make it undervalued. Again, this is simply an exercise to show that the PE ratio isn't all you should look at when valuing a stock. If there's anything I want you guys to remember from this video, it's that the PE ratio is a useful tool. However, it cannot be used in isolation to make an informed decision about a company. Alright, and that's it for today's video. If you learn anything, please give a thumbs up, like, comment, subscribe if you want to watch more videos like this, and I'll see you on the next one.